Welcome, everyone. Let's talk about a fascinating paradox in the world of business. What if I told you there's a simple, completely intuitive way to manage your company's finances that could also, if you're not careful, lead you straight into bankruptcy? Today, we're going to dissect one of the most fundamental concepts in accounting. It's a method that feels like pure common sense, but it hides a very dangerous trap for any manager who isn't paying close attention. So here's our roadmap for today's lecture. We're going to start with the central problem that all accounting tries to solve, this really interesting question of timing. From there, we'll define the simple solution, we'll explore why it's so tempting, and then we're going to watch it play out in a very real-world scenario. And finally, we'll pull out the critical lessons that will absolutely protect you as a future decision maker. Okay, let's get right to the very heart of the matter. Before you even think about software or spreadsheets or complex financial statements, you need to understand that all of accounting really boils down to one fundamental, almost philosophical question about timing.
Now, I want you to genuinely pause and think about this for a second. Let's say your company, your team, completes a huge complex project for a client in December. You've delivered the value, but the client doesn't actually pay you until February of the next year. So the question is, in which month did you truly earn that money? Your answer to this single question completely defines the reality your financial statements are going to show you. It changes everything.
So let's explore one very common and, frankly, a very intuitive answer to our timing question. It's an approach that on the surface feels like pure, uncut common sense. And here we have the formal definition. It is beautifully, elegantly simple. You forget about promises, you forget about invoices you sent out, you forget about bills that are due next month. Under the cash basis method, the only thing that matters, the only thing, is when cash physically enters or leaves your bank account. If the money didn't move, then for accounting purposes, the event simply didn't happen. Period. And that is the crucial point to lock into your brain, the golden rule. Under cash basis accounting, that massive project your team poured their hearts into in December, well, from an accounting perspective, it's a ghost. It didn't happen. Not until that check actually clears in February. The work you did, the value you created for your client, it's completely invisible on your books until the cash arrives. This black and white rule is exactly what makes the method seem so incredibly straightforward. So you might be asking, why on earth would any business choose a method that can just ignore major events like that? Well, its appeal is powerful. It's simple. But as we are about to see, this simplicity comes with a profound critical danger for any manager who isn't aware of the full picture. And here we see the paradox. On one hand, this method is so easy to maintain. Your checkbook register is basically your accounting system, and hey, it gives you a perfect up-to-the-minute snapshot of how much cash you have. But that is also its fatal flaw. Look at that phrase, an inaccurate representation of financial position. That's not a small thing. The moment your business starts operating on credit, selling things now that you'll be paid for later, or buying supplies you'll pay for next month, this simple method starts to lie to you. It starts to hide the truth. So let's be crystal clear about this. This is not a one-size-fits-all solution. For a very small cash-only operation, think of a food truck or a farmer's market stall, it can work just fine. But the second you need to report to any external stakeholders, like going to a bank for a loan or trying to attract investors for funding, they will demand a much more complete picture of your company's financial health, a picture this method is fundamentally incapable of providing. Theory is one thing, but let's make this intensely practical. We're going to move from concepts to consequences. I'm going to put you in the manager's chair with a scenario that shows you exactly why this distinction between accounting methods is one of the most important things you will ever learn in business school. I want you to imagine you are the founder and CEO of this company, Codecrafters. You've been working around the clock, your team is brilliant, and you're finally starting to land some really significant clients. You chose cash basis accounting because, well, it was easy, and you're far more focused on writing great code than you are on complicated bookkeeping. So it's the end of the fourth quarter. Your accountant walks in and hands you this income statement. You look at it and you are absolutely ecstatic. $100,000 in cash came in the door and only $20,000 went out. An $80,000 net income, that's a record quarter. Your bank account is full. You feel like you're on top of the world. Now your team is fired up. They're pushing to grow. They come to you and say, look at these numbers. We are incredibly profitable. It is time to pull the trigger, hire those 5 developers we desperately need, and lease that bigger office space. The pressure is on. The data on this slide seems to be screaming, yes, go for it. As the manager, as the CEO, what is your call? But hold on a second. That simple, beautiful statement is hiding a very dangerous reality just beneath the surface. Here's what's missing. First, you have $50,000 in what we call accounts receivable. That's money your clients legally owe you for work you've already finished and delivered. You have earned it, but the cash just isn't in your bank account yet. And second, you have $75,000 in accounts payable. These are bills you owe for essential software licenses that you've already used to do that work. Neither of these critical, legally binding events appears anywhere on your cash-based statement. And right here, this is the trap, laid bare. That glorious $80,000 profit? It's a mirage. It's a snapshot of your cash position today, but it tells you nothing about the true health of your business. When you factor in the financial obligations you've already committed to, that massive $75,000 bill you have to pay next month, the picture becomes terrifyingly clear. You are nowhere near as profitable as you think you are. This is the simplicity trap in action. If you, as the manager, hire those 5 new developers, sign that new office lease, and dramatically increase your monthly expenses based on that glowing but incomplete report, you could run out of money and be unable to pay your bills within a matter of weeks. We call that insolvency. A decision that looked smart, logical, and data-driven could literally bankrupt your promising young company. So, let's process this. What is the absolutely crucial lesson here? What do you, as a future business leader, need to take away from the story of Codecrafters to make sure you avoid this devastating mistake in your own career? Here are 3 steps that every effective manager must internalize. First, deeply understand your business model. If you buy or sell on credit ever, using cash basis accounting is a massive red flag. Second, and this is so important, learn to be skeptical of your own data. A great manager doesn't just read the numbers on a report. They constantly ask, what is this report not telling me? What's missing? And finally, you have to choose the right tool for the job. Your accounting method is a strategic tool. It must serve your strategic goals, not just be the easiest option available. I want you to burn this idea into your mind. A textbook phrase like inaccurate reflection sounds so mild, like a simple bookkeeping issue. It is not. In the world of management and decision-making, it is a catastrophic failure. A strategic blind spot of this magnitude is like trying to drive your company forward at 100 miles per hour while only looking in the rearview mirror. It doesn't matter how great a driver you are, eventually you are going to crash. So I will leave you with this final thought. Throughout your careers, you will constantly be presented with data. Some of it will tell a simple, happy story that makes you feel good and confident. And some of it will tell the complicated, often messy, but complete truth. As a leader, which one will you have the courage to listen to? Your answer to that question will define your success.